Welcome to the Money to the Masses podcast, putting you in control of your finances. One mic, two idiots, and, according to our latest figures, 3 listeners. Here are your hosts, Damien Fay and Andy Leaks.
Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, Money Farm. Now, Money Farm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 142 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, good to see you back. You look like a man who's got the world on his shoulders. You look like you've been busy.
Do I?
In the nicest possible way.
I sometimes feel like that. No, I have been busy, and there's been so many things that are coming together at the same time, and from Money to the Masses and personally, but also there's always the added element of investment markets. And I've been doing a lot to do with investing this week on 80/20, which one of the pieces today actually will take something from what I've been doing, but not to date the podcast. At the moment, we are equity market highs and sort of all-time year highs, and there's a lot in the press about the possibility of a correction, which, if it does come, we're overdue one. It would be the most anticipated on record, let's be honest. So I've been doing a lot about that, the possibility, what to look out for in markets in terms of numbers on things like the FTSE or US equity markets, and trying to give people a steer on 80/20 investor in a kind of like roadmap way of what you might want to expect and what you could do. And so that's quite draining, it's quite hard, it's quite intense, but it's really good to do anyway, just to sort of to give everybody a steer and to sharpen your thinking. So I've got that feeling of a lot going on.
Just to slightly step back slightly, we may have some new listeners, we may have some beginner investors, and they may not know what the phrase a correction means. Do you want to I tell you what, as if I actually do know because I've been listening over the last year, but imagine I'm a new listener. Tell me what a correction is in 30 seconds. There's your challenge.
In 30 seconds, a correction is quite simply when the market falls 10% from its previous high. So that would be, at the moment, we're 7,500 on the FTSE, or we were, so you've got to go down 10% below that. But there is another additional level, which is called a bear market, is when you fall 20%, and they happen periodically. We've not had one for quite some time, a year or more, and they do arrive probably every year, 18 months or so.
Great. That was in 30 seconds. Good stuff. And why do these things happen? Is it basically nobody knows, or is it a mixture of different things all culminating together?
It is a mixture, actually. Probably one of the best analogies. I tend to go back to it a lot because it works, and it's surfing. If you imagine that equity markets are like waves, so you get big waves up, and therefore they eventually will crash and come down. Now, the general trend over time, if you look back going 100 years, is a general uptrend in the equity markets. Now, that does mask some huge corrections, like we had the dot-com bust, and we also had the financial crisis when we saw markets tumble 20, 30, 40% in some cases, and that happens periodically all the time. And part of that is, it's mostly down to human behaviour. We have a tendency, we'll buy things on the way up and then we'll sell them as they start to fall. So it's fear and greed which drive nearly everything, even though there are fundamentals underlying the values of stocks and shares, like companies' earnings and profitability. But there's a lot of human behaviour, and in fact there is something called Elliott wave analysis, which, if anybody's interested, they could go and read about it, which a guy, I think it was back in the 50s, when before we had all the supercomputers, really got to notice some patterns that formed in regular intervals in equity markets. So there were waves of sort of a sequence of 5 waves and downward ones of 3, that if these certain scenarios happened, then they repeated. It's a bit like fractals, like on a snowflake, to say what a fractal is, but like a snowflake, the idea that the pattern you see when you look at it, if you zoom in, then you see a similar pattern. You can almost go on forever, and it's that's what a fractal is. You get these patterns that are repeated almost infinitely if you keep zooming in on it. And markets are like that. If you zoom right out over 20, 30 year periods, you see these waves. If you zoom in on a daily or hourly basis, you see them again, and they repeat. And that is all down to human behaviour and the way they interact, fear and greed and prices. So to answer your question, Andy, it is a bit of everything that's sort of muddled in, a lot of human behaviour, but it means that you can try and not predict, but you can almost, you can pick a range of possible future outcomes based on mathematics, effectively. And that's actually what I've been doing a lot this week, which is quite appropriate you ask the question, actually, because that's what I've been doing, is taking some of that analysis and saying, look, if we go below this level, this is what you get as a support level. And if what will probably happen is we'll bounce off that, because what tends to happen is previous highs in markets end up being supportive lows for a sell-off, if that makes sense. So as you go up, what tends to happen is you get to a new peak, and then the market will either go down or up. And if it goes up, then you'll set a new high, and the previous high ends up being almost like a floor where people will retrace back to in the sell-off, and it will provide a bit of support for the market for it to bounce up, or if it breaks through that, it might keep going. And that those support levels also become lines of resistance when you go up, if that makes sense. So there's kind of lots of lines you could draw on an equity chart with just a ruler and a pencil that anyone could do, that can show you rough trends. And if you're interested, go and look at 80/20 Investor, do the free 30-day trial, and I go through and I do it. It sounds far more complicated than it is, but it doesn't need to be. So I've been doing a lot of that and showing people where the markets could be going in America, Japan, UK, even the pound, and sort of setting their expectations, really.
So yeah, do go and check that 80/20 Investor out. I do it myself, and what Damien effectively does is he provides all of the tools for you to be able to go and be the best DIY investor that you could be. There's all sorts of bits and pieces, analysis, and it's all there in one place. And mark my words, you will enjoy it. Right, so we kind of went off piece there a little bit. What have we got coming up in the rest of the show?
Right, in the rest of the show, we've got a quick piece on investing. Somebody in 80/20 asked me a really great question about what sort of things to buy if the market collapses. And I just want to touch upon that because it's quite insightful, the answer. And there are two other things. One is to do with car insurance, and it's 10 simple things people do that actually invalidate their car insurance, or could mean they won't be paid out in the event of a claim, which they don't realise invalidates their car insurance. And the final one is something that came as a result of me talking to my hairdresser. When I have my hair cut, inevitably you talk about lots of different things, and we started talking about wills and leaving money to people, and actually the important idea of what happens if you want to cut somebody out of your will, because there have been people and test cases where people have been able to challenge the will of somebody who's died and actually get paid out of their estate despite it being against the person who's died, despite it being against their wishes. So how can you stop that, or can you even? And this was the conversation my hairdresser and I had, which maybe seem a little bit unusual, but I'll explain why we had it a bit later.
Great. So we've been talking investment already. Shall we do the 80/20 piece, the question you've had?
Yeah, the question was quite a straightforward one. Basically, the person asked me that if the markets start to go downwards and struggle, should you buy equity income funds? Because at least you're going to get paid a dividend or an income, which could hopefully see the value of your assets go up. So to give that some sort of background, when you invest, you can invest for growth, so you just want the pot of money to go up. You can invest for income, so the pot of money tends to stay broadly the same, might grow a bit, but you take an income out. But you can reinvest that income, or you can do a mixture of both. And most people tend to be the growth or a mixture of both, to be honest. You only tend to invest purely for income if you're retired and you're probably drawing on your money. Now, the idea being that if you're in a downturn, perhaps just getting something that will give you an income is better than nothing. And I actually just wanted to pull out this question because there is a hidden explanation that it's more insightful than the person realised when they asked the question. Because the first thing to think is that if the market starts to tumble, then no matter what you hold, it's probably going to fall as well. So even if it's paying you an income, and that income happens to be 5% a year, then the value of the shares are probably still going to fall, because when in a mass market sell-off, it's kind of all ships sink at once, generally. Not necessarily to the same extent, but they do. So that won't necessarily offset the fall in capital value of the share price. So it's not quite a perfect scenario. And the other thing that they're assuming is that the income paid by any share or any fund that invests in a range of shares will be maintained. And the reason that I bring that up, because if the market sell-off is an indication of some kind of economic slowdown or some wider problems, then the companies paying the dividends may no longer be as profitable, which means the dividend comes under threat. So to pull that together, what it means is generally if you buy income investments, you should try and buy ones that pay reliable dividends that grow over time, and the same applies to funds. Now, to find funds that do that is quite difficult, and that's the reason why on 80/20 Investor I produce a kind of a heat map. It's a chart that's colour-coded that shows people which funds grow their income over time and have the most reliable payouts. No one else does it, so that's why I do this, to help people. So it's a great way of picking. If you were going to try and pick an income fund, then you pick the ones that have grown their payouts through thick and thin, even through the financial crisis. Now, the reason why it's quite an interesting question is because, setting aside the fact that you might not be able to offset the capital value, the fall, with any income, what actually happens when equity income funds that are trying to be consistently paying out income over time and grow that, what they tend to do is they tend to gravitate towards sectors. So the fund managers tend to choose sectors that have reliable businesses through recessions and even booms. So they're quite boring companies, and they think about things like drug companies, because in a recession you don't take any less medicine than you do when the economy's booming. Equally, when the economy's booming, you don't take more medicine, and you take what you need. People will always use it. It's the same as tobacco companies. Tobacco companies, people don't, I would argue, smoke more or less in any given environment. So what happens is that their revenues tend to be slow and steady, relatively boring, or for want of a better word, defensive. So their slide and rallies, or whatever, the movements in their price are less dependent on what's going on in the economy. So if we have a big downturn in the market and we have a big downturn in the economy, by buying equity income funds, what you're doing is moving into these defensive sectors. So, ironically, by buying equity income funds, setting aside the income, you'll probably end up buying defensive sectors anyway as a result of the manager trying to build this sustainable income. And therefore, the capital value of your portfolio could theoretically do better anyway. So that's why it's a really interesting question, because it's not for the income it necessarily produces, it's the effect of trying to produce that income that has on the actual value of the shares. So equity income, it won't protect you in any downturn, but it's quite an interesting sector. And what tends to happen with things in the past, like we've done 80/20 Investor and the sort of momentum algorithm that's built into it, in those big downturns, you'll see that the equity part does start to move towards those income funds. So it's a very intelligent question, and it actually gives me the opportunity to share a little bit of insight into the background. But there we go, Andy, we're done on investing for this week. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers, and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so we're going to talk about car insurance and the 10 things that people don't realise could invalidate their car insurance. And I'll be honest with you, Damien, when you mentioned this earlier in the podcast, my heart skipped a beat. So I'm hoping you're not going to tell me something that's going to invalidate my car insurance that I've done. So fingers crossed. Looking forward to this, kind of.
Yeah, this piece was carried out by one of the comparison companies. I'll name check them. I think it was USwitch. They often do these sorts of things, companies, to get in the press and get a bit of promotion. And if they've done the work, why not give them the nod? Now, they've come up with 10 common, simple mistakes that drivers make that can invalidate their insurance. And I just thought it was quite a light but interesting piece, because there are so many things that we do and don't realise. Because I don't know if you ever tried to read the T's and C's on any insurance policy, let alone a car insurance policy, then it can be mind-boggling, to say the least. Now, the 10 things, I'll just go through them. These are in no particular order. Actually, no, I lied. They are in a particular order. I've just noticed. They were in order of the people, the most frequent to the least frequent. So I'll do it in a backward fashion to build a bit of drama. So the top 10, we'll go from 10 to 1. So number 1 is the most common thing that people do to invalidate their insurance. Now, number 10 is underestimating the mileage they travel every day. Now, when you apply for insurance, you're supposed to, or you have to state how much mileage you do in a year. And obviously, the lower your mileage, the cheaper your premium tends to be. It's the same when you take out any kind of credit or loan when you're trying to buy a car, when you're buying a new car, that is. So, understating your mileage can make your policy cheaper, but it will actually invalidate your policy, because there are higher risks. The more you drive, the more likely you are to crash. It's just a simple equation, really. And the understating your mileage is one that apparently 8% of people do. Now, the 9th one is to forget to renew your tax. If you're driving around without tax, that invalidates your car insurance. And I suppose these days I can kind of see that people might forget, given that we don't have those shiny tax discs anymore. Right, number 8 is an interesting one. Having fluffy dice or anything similar hanging from your rear view mirror. And so many people seem to do that. Magic trees and air fresheners. Apparently, that can invalidate your car insurance, which I thought was incredibly interesting. I don't know how people drive with those things. Like my niece does. She drives around with all these things hanging down. I think, how can you see out the window? But maybe I'm just being a fuddy-duddy. Not updating your job details. Now, this is an interesting one, because your job title impacts your insurance. And it's because the type of job you do is supposedly going to dictate how you drive. So I'm not talking about being a Formula 1 driver. I'm talking about being, well, a good example, this happened to me and my wife. When we had our first child, and she therefore stayed at home for a period of time, when she told the car insurance company that, our premiums shot up. And the only thing that changed on that year was her stating that she was therefore at home and staying at home to look after our children for that year. And I called the insurance company, and they said, yeah, it's because mums are more distracted. If they've got children in the car and they're driving around, they're going in the rush hour, the school run. I'd have to say, the school run around where I am, you're taking your life in your hands anyway. I mean, people drive like nutters. But that is the reality. Apparently, there are more chances of a claim. And funny enough, we did have a claim a few years ago on the fact that somebody just drove into our car outside the school. When my wife went to pick up the car, I think a lorry had reversed into the side of it and then had just driven off. So perhaps there is obviously some truth in it. They don't just make these numbers up, even though it does feel slightly sexist. So your job does impact your car insurance premium. But on that,
would you recommend that people should be completely honest and not try and play the system? I've heard, for instance, that comedians who notoriously travel from the top of the country to the bottom of the country, they do a lot of miles, but as soon as they mention that they're comedians on their car insurance, it just goes through the roof. But it's not just because of the miles they're doing, it's because they're going to be parking pub car parks and, you know, the like, late at night and things like that. So a lot of them change their job title to public speaker, which theoretically they are speaking in public, but they should be honest, I think.
Look, they should be honest, Andy, but there is nothing wrong with changing your job title. We did a piece before, I've forgotten the term, it's got a name actually, that was coined for doing this, that you can change your name of your job, for example, solicitor and lawyers, that you might effectively be doing the same thing, but the premium for your car insurance can be wildly different. Now, over the years, I did a load of analysis once, and the Telegraph printed a huge table of all this analysis that I did. And the variations have reduced, and I think they've cottoned on to the idea that people do this. But there are some differences. I mean, there were things like calling yourself a builder rather than a bricklayer and things like that had significant differences in premium. And they were quite significant. Sometimes it was 10-20%. So by all means, be honest, but there's nothing to stop you just changing the name of or the term of what you do, as long as it's still within the realms of truth. The next one is don't lend your car to a family or friend. 14% of people do that. Don't let pets roam free in your car. I see people do that all the time. I mean, roaming is quite... roaming, to me, gives a vision of them going across fields and set free. I think just jumping around in the car is what they mean and distracting you. Hanging their heads out the window, as dogs like to do. Forgetting to renew your MOT on time, 16%. And now the top 3 are putting off car maintenance when required, leaving your car unlocked, and wearing high heels or flip-flops while driving. Apparently 25% of people do that. So as we've not had an English summer this year, I don't think we've got to worry too much about flip-flops. But it's a good list of things that you should not do and avoid because it could invalidate your insurance.
And I can breathe and relax now. It seems that I'm fully insured and everything's good with the world. So that's good. Okay, so the final bit is about you and your hairdresser talking wills.
Yeah, that's exactly what it is. If people ever want to know why you might get scruffy financial advisors or mortgage brokers, I can tell you that they have slightly dishevelled hair. It's because they don't actually like going to their hairdressers, because once people find out what you do for a living, everyone wants free financial advice. That's what happens. And I knew somebody who you actually know, Andy, funnily enough, who just gave up going to the hairdressers and accepted the dishevelled look because he couldn't stand having to talk about mortgages every time he went. And one of the things that my hairdresser, he's just a local barber, and he's a really nice bloke, and I get on really well with him. And what's been great is I first went to him when I quit my job and started doing Money to the Masses full time. So I feel he's been on part of this journey. He's always asking me, how you getting on and whatever. And he's a really nice bloke, and he doesn't talk about money. He just shows an interest. But he'd been unwell in the last year, and so we were talking about. He got onto the subject of when you die and kids and things, and he started talking about wills. And the reason I wanted to bring it up, because he happened to mention about the idea of what happens when you cut somebody out of your will, say one of your children, and whether they can go to court after you've died and try and change your will. And so I just thought it's quite an interesting topic, particularly given that Donald Trump seems hell-bent on trying to start a nuclear war this week. I mean, if you're listening to this in the future, then it's obviously good news, because we are still around, unless, of course, you are in a bunker while the nuclear winter rages overhead. But the
positive
stuff we're going to finish on this week, just a very quick bit on it, that there was a court case that happened a few years back that set a precedent, and under the Inheritance Act, people can challenge a will. So if you have a child who you some reason fallen out with who's an adult, you could decide, I don't want them being in your will, and then when you die, they can try and challenge it in court. And what actually happens is that the court will look at the case, look at their financial and personal circumstances, the circumstances of your relationship with them, and try and see whether they are able, at the time that you die, whether they're able to sustain their own living, they're able to afford to live, etc., and then make a judgment whether you should have, in fact, or whether they should have been entitled to a portion of your will. So there have been cases where people have cut family out of wills and they've successfully overturned it and actually end up inheriting part of it. So the fact that can occur, is there a way you can try and stop it? Now, you can't stop it as such, but what you can try and do is, if you are going to do that, you can write a letter associated with your will that can state the reasons why you have decided not to include somebody in your will. So say one of your children you decided not to include, and you've actually included another one, you need to obviously give good reason as to why you've done it. And in that case, if they were to take your estate to court effectively to try and overturn what your will has said, then there could be very good reasons why the judge might reject their claim. Now, of course, there is the alternative scenario where you may have people who, let's say you decide to give somebody their inheritance early, but you don't want them to inherit anything from your will. So you're trying to give your children, for example, their money up front so that they can use it now, but you don't want them to inherit anything later because that's your choice, you've given them it early, and say your wife is inheriting everything or your husband is inheriting everything. And I saw an interesting discussion about what you could do in those instances. Could you stop your children going back and saying, hold on a second, I've not got anything in the will now my dad has died. He should have given me something. And therefore they get almost a second bite of the cherry. Now, again, you can't stop them doing that, but you can put something in the will that stipulates that they inherit something on the basis that they don't bring a claim against your estate. Now, of course, that doesn't stop them later bringing the claim once they've got the money, if they haven't already done so. So they could get the money, but then they could bring a claim later. But what it might do is it might deter them, and their legal experts might turn around and say, there's a decent sum you're going to get in the event that your dad's died if you don't make a larger claim, even though you feel you're entitled to it. Because if you lose, you're going to have to pay costs, and you're going to lose that inheritance anyway. So what you can do is not give them their inheritance now. You could actually just give it to them in your will, but stipulate they can't come back for a second bite of the cherry. It doesn't, again, like I said, it doesn't stop them doing it, but it's one of the things that you can do. But again, it was just an interesting conversation to have, that I don't think people realise that your last will and testament isn't necessarily set in stone, and it can be challenged. And so if you are going to do something where you are going to, out of spite, either exclude someone or you're going to be generous and give them their inheritance early, you might want to actually talk to a solicitor and draw up a letter. It can just be a letter, it doesn't have to be anything more formal, that stipulates what your intentions are and why you have done it. So it's just a nice piece for people to be aware of and to look into if that is you.
Good, we're done.
We are done. And the reason that related to my hairdresser was because, like I said, we were discussing around the idea of him not or including people in his will, or whether he wanted to in his own family situation. So that's why it wasn't just completely random that me and him just talk about weird things like this. It was actually spurred by ill health and stuff like that. But he's a very nice guy, and I'm sad to say that I think he's actually retiring later in this year. So he's finished his journey. He's going off to retire, and I'd love to see where Money to the Masses ended up one day and talk to him along the way. Because there's very few people on your journey when you do anything. It's always nice to see people who were there supporting what you did, even if it was only verbally at the beginning.
Yeah, nice. I hope his family situation improves. People should learn really not to fall out with family members who basically for a living work with razors and scissors.
Yeah.
You know what's coming your way.
Yeah, but it doesn't always have to be for negative reasons. It can be because you just think one of your children
deserves more.
Or it's just, you might just decide, you know what, that one of your children may be successful in their career and may be better off than the other one. And you might decide, therefore, to actually not split it equally or something like that. So you may get somebody come back and go, hold on, that's not right, I should get an equal amount. So that's why you can get people doing it for very valid reasons. It doesn't always have to be negative. And so as long as it's stipulated as to why, it limits the ability for them to challenge it. So there we go. We've had 3 pieces this week that covered a variety of topics. So as ever, make sure you do leave a review for us on iTunes, and you can contact me via Twitter as normal, Andy. Money to the Masses with the number 2, and of course you can email me, Damien at moneytothemasses.com.
Great stuff. So is that all the admin done?
The only other thing is, do download the One Giant Leap podcast series and join the group, because I think you'll love it and it will inspire you to follow your passion. Right, that is it, Andy. We are done.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.